He's been called the Oracle of Omaha, the Sage of Nebraska, and from a young age, he knew he would be rich.
Warren Buffett needs little introduction. He's the godfather of modern-day investing.
Warren Buffett
And yet there's only one Warren Buffett.
is the chairman and CEO of Berkshire Hathaway, Warren Buffett.
Let's take Warren Buffett of Omaha, Nebraska. If you would put $10,000 in 1965 into his company, Berkshire Hathaway, you would have $1 million today.
Warren Buffett, often called the Oracle of Omaha, is one of the most successful investors in history. His investment strategy, built on patience and value investing, has made him a billionaire and a respected figure in the financial world. Buffett honed his craft under the legendary Benjamin Graham, the father of value investing and the original dean of security analysis at Columbia University. His approach, based on sound judgment and rational decision-making, has stood the test of time. In 1985, Buffett granted a rare interview to George Goodman, a financial journalist writing under the pen name Adam Smith. This candid conversation, aired on PBS's Adam Smith's Money World, offered a unique glimpse into the mind of a future investing legend. The interview provided a valuable insight into Buffett's early investment strategies, his approach to risk, and his enduring philosophy of patience and value.
I don't think Warren has ever been on television until this interview.
What's fascinating is that despite his immense success, Warren had never appeared on television before this interview. This conversation offers a rare glimpse into his thoughts and strategies at a time when he was still relatively unknown to the public.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Buffett's investment philosophy is grounded in simplicity and discipline. One of his most famous rules is deceptively simple. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. If you buy assets far below their intrinsic value, your chances of losing money diminish significantly. It's a method that relies on patience and sound decision-making, not on gambling with market trends.
Warren, what do you consider the most important quality for an investment manager?
It's the temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha. But you do not have to be able to play three-dimensional chess or be in the top leagues in terms of ring playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reason are right.
When asked about the most important quality for an investment manager, Buffett emphasizes that it's not intelligence, but temperament that matters most. You don't need a high IQ to succeed, but you do need a stable personality, one that doesn't take pleasure in following the crowd. You're not right or wrong because thousands of people agree or disagree with you. You're right because your facts and reasoning are sound. This mindset is crucial for staying rational, especially in a market that often behaves irrationally.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that. But they do not really think of themselves as owning a piece of business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about it. Business figures themselves tell me something about business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Unlike many money managers who obsess over short-term stock movements, Buffett takes a radically different approach. He views stocks as ownership in a business, rather than just fluctuating prices. To him, the stock market could close for 5 years, and it wouldn't matter if he's invested in the right companies. He looks at a stock's price only after he's valued the business, ensuring that he's not influenced by market noise.
How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth. I don't need to be in New York to figure out what some other company is worth. Simply, it's an intellectual process. And the less static there is in that intellectual process, really the better off you.
What is the intellectual process?
The intellectual process is defining your area of competence in valuing businesses. And then, within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value. There are a few that I am competent to value.
One of Buffett's key advantages is staying far away from the chaos of Wall Street. He believes that being in that environment would make him poorer due to the constant noise and overstimulation. At his office in Omaha, Buffett can focus purely on understanding the value of businesses without being distracted by the latest market chatter. He explains that this is an intellectual process, requiring you to understand your own limitations and focus only on what you're competent to value.
I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about, and that may be too bad. But why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily, and you don't have to make any decisions. You have to make nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!" from the stands, and that's very tough for people to do.
Buffett isn't swayed by the pressure to make decisions constantly. He compares investing to a baseball game where there are no called strikes. You don't have to swing at every pitch. You can wait for the perfect opportunity. While this approach may seem boring to some, it's a core part of his success. Professional money managers often feel the pressure to act from clients who are yelling, "Swing, you bum!" But Buffett stays patient, only swinging when he's confident.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That, the academics, for example, focus on all kinds of variables. Partly because
by academics, you mean professors of
right?
finance?
The data's there.
In business school.
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, that to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. It's what I think about it when buying stocks. Stocks are just pieces of businesses.
Despite its effectiveness, Buffett's approach is often overlooked because of its simplicity. He believes that academics and analysts overcomplicate investing by focusing on variables that aren't truly important. Whether you buy a business on a Tuesday or in an election year is irrelevant. Instead, Buffett focuses on the business fundamentals. Stocks are, after all, pieces of real businesses. His method of valuing companies first without looking at the price reflects his disciplined, long-term approach. Buffett's timeless wisdom proves that successful investing doesn't require complex formulas or insider knowledge. His focus on temperament, patience, and simplicity offers valuable lessons that anyone can apply to their own investment journey.